and welcome. You're watching News 9. I'm Shweta Kothari. We're bringing you stories from the world of business policy and economy. First up, Forex cards can now make your international travel costlier, as Forex cards and cash for foreign spends have been kept out of the 7 lakh TCS exemption limit, unlike credit and debit cards. Also on the bulletin, funding winter in Indian startups linger on as foreign VCs funding in India declined 72% so far this year. And airlines start new flights on Go First routes, but fare spikes remains a worry. Also, shortage of electronic components continue to affect production at Maruti, even as sales rise 6.5% in April. And Netflix crackdown on password sharing has finally started. On the show, everything you need to know about streaming giants' new salvo. All that and more on this bulletin. With me is my colleague Karthik Malhotra. As usual, Karthik, good morning.
Hi Shweta, good morning. How was your weekend?
My weekend was good, but lots of news coming in there. Good and bad, but let's start with what we are calling as our top story at this point in time, and that is funding winter in Indian startups continue to linger on, and I think it's an important story because we've been discussing how FPIs in India is increasing, but at the same time, startups continue to dwindle in absence of enough foreign funding.
So Shweta, this is not something that was completely unexpected, but such a massive dip, 72%, is not something that many people had expected, me included. Now, what happens in an economic cycle is that, why do VCs really take a punt on startups? VCs take a punt on startups because they believe somewhere down the line there is going to be another round of investment, which is going to make their original investment far more valuable, and they're able to withdraw and make a quick buck. Okay. Now, of course, investing in startups comes with its own set of risks as well. So what happened with the high inflation in the US and interest rate being, taken higher and higher in every consecutive month by the US Fed, it just made investing in the US Treasury a far more lucrative option. Okay. So what startups do is, at a time when they see that there is global uncertainty, when they realize, when VCs realize that it may not really yield enough rich dividends, sustained dividends in an environment where there are talks about recession, where there are talks about an overall inflationary environment, and it becomes a little unviable for VCs to take those risks on a sustained basis, as a result of which they decide to hedge their investments by parking money in a safer haven like the US. And that is exactly the cycle that we have seen. Now, the numbers are quite interesting actually. You've seen total investments, and I'm talking about foreign direct investments through VCs into Indian startups. Yeah. They have dipped from a 16.2 billion to about 4.58 billion. So this is a massive decline. Yeah. So this is a massive decline. And what are the headliners? The headliners include Accel, Sequoia Capital, Tiger Global, SoftBank. These are all major investors who have taken part in the Indian startup ecosystem. They have built or helped build companies like all the unicorns that we know of, from the likes of Flipkart and Ola to Daily Hunt and what have you. So these companies have sort of taken part in building, fostering the Indian ecosystem. And then suddenly they realize, like the rest of the world, that startups and their journey to profitability is often a long run one. Okay. So does it make sense to stay invested and keep pumping in dollars without a potential high value exit? And I think the answer they arrived at was no. And hence, the funding has dried up. So globally, it's not just India.
In fact, I was about to come to that.
It's a global funding winter.
Is it specific to India? We understand viability of startups is a question mark, not just in India, but many other countries. But in India specifically, we're looking at a 4-time decline over a course of 1 year, which was 365 days. Is there something that triggered that decline in terms of a policy move or a big startup going under, or is it gradual on expected lines?
So see, good question, Shweta. You have seen Byju's, for example, plummet like no tomorrow. It was a business that was built in the thick of the pandemic. It had enormous number of takers. It was raking in dollars. It had hired enough and more people, which again became a little redundant once schools started reopening. So, so that could have been one of the potential triggers in the overall environment of startups, right? And edtech as a whole, I don't want to single out Byju's, but edtech as a whole has taken a beating, right? But I think to answer the larger question, this problem is not India specific. The funding winter has been there in the whole world for exactly the same reason, that startups will take time to return profitability. They will take time for your capital to appreciate, and another equally powerful, potent VC coming, investing at a higher valuation that an existing VC can cash out and make his or her money.
Right.
But I think the challenge really was that with the economic downturn, the potential economic downturn, with inflation, with the Russia-Ukraine war, with China's sort of supply chain hit with the zero COVID policy, overall the boom that was there in startups during the pandemic has taken a complete beating the world over. And that is the reason why VCs are pulling out, and they have thus far been investing in the US bond market, US treasuries.
And we've seen a sustained effort by investors to push startups to, you know, even if they have to scale down operation, to come up with profits on their books. And you know, we've seen this in case of unicorns, and we've discussed this widely, how big numbers are less important than profits on the book, even if a company is not a unicorn. And we've seen unicorns declining in 2023 so far. In 2022, we saw many unicorns in the first half, almost 6 to 7 in the first half. No unicorn entering that club in the second part of 2022. So essentially, as from what I understand, the bigger thrust here is for profit on books as opposed to scaling up of operations, going big with numbers. You need to be able to make money in order to sustain. It doesn't matter if you're big or small.
So it works both ways. There are cases where profitability is elusive for a very long time. But if you look at the last 10 years or so, VCs have continued to invest in those businesses. Why? Because those businesses are working on scale.
Okay.
They're working on innovation, new product delivery, new vehicles of delivering a product or a service. But at the base of it has been a large customer base that needs to be acquired. And once you've acquired a large customer base, the thinking in the VC circles is that sooner or later profits are going to follow. So the pressure on profitability has not been as high as the pressure on scale from VCs, because they feel there's no point getting a 5%, 8% profitability right now. It's better to capture the market. Go carpet bomb, get as many customers as you can, burn cash in the meantime, that's all right. You know, spend on advertising, do big ticket technology spends, no problem at all. Carry on carpet bombing, capturing the market, and profits will follow.
Okay.
But again, how long are you going to take those risks? And the risk is not only on profitability versus scale. The risk is, am I better off today investing $100 million in a startup with a lesser likelihood of another VC coming and valuing the same investment at $200 million, and I can walk away with a $100 million profit, rather than invest it in a safer option like the US bonds, with a yield of maybe 6%, 8%, and draw in at least, you know, some sort of a return on that investment, rather than parking money in a place that may not yield something significant in a near term.
Okay, and before we move on, while there is absence of easy money now, many startups in India have also shelved their IPO plans, and I'm looking at a list here: Boat, Go First, MobiKwik, VLCC, Oyo. It's not looking too good right now for startups in India. And how long do you think is that going to continue? Because this has been a prolonged funding winter.
So again, you know, startups that find easy money will continue to get easy money.
Okay.
But easy money beyond a point dries up for everybody. Now, when you list on the markets, scale is not the only thing that the retail investor or the institutional investor is looking for. Markets are very clear. They want a clean P&L. They want a very robust balance sheet. They want a good order book, right? We've seen in the case of startups that did go ahead and list. Look at Paytm, look at Zomato, look at Nykaa. These were three big startups, among the biggest, in fact, in India, right? All unicorns. They listed. And what happened? They didn't have profits on their books. They didn't even have actually a very clearly defined business model, so to speak, especially in the case of Paytm, if I can, you know, stick my neck out and say there wasn't a business model. Markets understand those patterns, and markets start getting very spooked if they see too much red on your balance sheet or on your P&L. At the same time, Paytm also had other problems before it listed, which was infusion of capital from Chinese-based investors, which came under the government's radar, and then obviously, there was the whole issue around that. But investors, when you list on the market, want to see profits on the books. They don't understand the game of scale and carpet bombing and capturing the market. Now, there was also a time when a lot of tech startups preferred to list in the US as opposed to listing in India. And Flipkart was one of them. PhonePe was contemplating that. And many other startups in the tech space wanted to list on the NASDAQ, which is known for technology listings, rather than list on Indian markets. And at that time, there was, I'm talking about 2021 or so, there was also this blank check company concept called SPAC listing, through which a consortium of investors would form a special purpose vehicle, and your company becomes part of that SPV that lists on NASDAQ. There was great excitement around SPAC listing, but US markets have also taken a beating. So at a time when companies that are contemplating listing but are not sure of the economic environment in the US, with a recession likely to be underway, we've been talking about it almost every day. Debt crisis has finally, the negotiation has closed and there has been an up in the debt ceiling. But at a time when you don't know which way the markets are going to go, will you want to risk listing your company at a time when markets could actually tumble and crash on a NASDAQ sort of an exchange? Many people don't see value in that and aside them for that. Maybe it's better to wait it out, let the downturn, if at all it ever happens, hit the rock bottom, and when things start to look up, that is when look at an international listing.
Okay, listing there is on hold for a lot of Indian startups, and given that the market is not allowing them to list so easily, it is becoming increasingly difficult for many of these big startups, for that matter, from MobiKwik to VLCC, to be able to go ahead with an IPO. We will of course keep tracking that story, but shifting focus to another important story that we're tracking, and that is international travel, how expensive it is to travel at this point in time. And whichever route you take, you carry cash in hand and you carry a credit card or a debit card. Even if you carry a Forex card, carrying a Forex card in fact is all the more expensive as opposed to carrying a debit or a credit card, because there is no limit on TCS. I mean, there is no threshold mark. So it essentially means even if you're spending 1 lakh rupee using a Forex card, you will still attract 20% TCS, Karthik, starting July 1st.
From the 1st of July, that's right. So, travelers' checks or Forex cards, travelers' checks actually converted themselves, sort of, the metamorphosis happened into Forex cards. And Forex cards were actually almost as good as carrying cash, with the security of plastic and the lesser risk as compared to carrying physical cash in your pockets. So, so Forex cards really found their market, and you had every bank practically issuing a Forex card. You had the likes of Thomas Cook issuing Forex cards, which continues till date. But unfortunately, with this new ruling on TCS, there was public backlash which got the government to retract its stand on credit and debit card spending internationally, and they were brought into the same ambit of 7 lakh rupees, and only above that would a 20% TCS apply. But that limit, like you said, of 7 lakh rupees on Forex cards and cash conversion is zero, which means now owning a Forex card, and if you want to load up a Forex card with 1 lakh rupees, that's the example you gave, from the 1st of July will actually be 1,20,000 rupees of your cash gone. So, Forex cards otherwise had great advantage over debit and credit cards on multiple factors. Number one, there was no very low markup fee, right? Number two, there was hardly any transaction fee. In most cases, anytime you swipe. So, what's a markup fee? Let's look at these three components: Forex, markup, and ATM withdrawal.
Sure.
So, when you carried a Forex card, the markup fee, which is actually the fee that the bank that loads your Forex card charges over the spot rate of the exchange value of the currency. So, let's say currency, a US dollar today is trading at about 83 rupees. The Forex card, when you load that up, would charge a very nominal 0.25% or so markup fee when you load your Forex card with, let's say, the 1 lakh rupees.
Okay.
But what this did, why you did not mind paying this, was that when you're traveling abroad, and let's say you're abroad for a period of 7-8 days, a month maybe, the currency prices could fluctuate.
Okay.
So when you use your credit card or your debit card, it would charge you the conversion day of that day.
Right.
Plus an additional markup, plus a transaction fee and all of that, right? So you locked in a rate when you loaded money into a Forex card. But you paid a very small markup fee.
Okay.
Then every time you used your Forex card internationally to swipe at any store or any restaurant, there would be no transaction fee. And anytime you withdrew money from an ATM, it was advised that withdraw in bulk, because there was a little 150, 200 rupee ATM withdrawal fee that you would pay on a Forex card. Compare this to credit cards. On a credit card, you don't safeguard yourself, because anytime you swipe, it is that day's exchange rate, spot rate, which is applicable, and the markup rate is high. Credit card companies have charged up to 3.5% as markup fee. So 83 rupees to a dollar spot rate today, add a 3.5 to it, that makes the dollar more expensive by about 2.5 rupees. So it'll end up, every transaction of a dollar, instead of being 83 rupees, will end up costing you about 86 rupees.
Okay.
Right. Next is your transaction fee. Over and above that, banks would charge a 2.75% or so transaction fee.
Every time you
swipe, right? And every time you went and withdrew money from the ATM, there would be an additional transaction fee for that also. So overall, using credit cards and debit cards internationally was far more expensive than loading money in a Forex card. For people like us, it would also keep us restricted into a budget that, hey, spend no more. This is where you should stretch yourself and nothing beyond that.
Right.
But now with this 20% with no threshold of 7 lakh rupees added on Forex cards, obviously it undoes every other advantage on account of markup fee, transaction fee and exchange fee, which were advantages for Forex cards.
Not looking too great, and I'm still trying to understand, decipher as to why is there an attempt to charge as much as 20% and not a 5% or a 10%? I mean, and this basically, this logic eludes me. I don't know why this is happening. I don't know what the reasoning is behind this move, and surely I personally don't understand why there has to be a 20% charge if you were to be able to identify people who are spending money abroad and more money than what they're declaring. You could easily do that by charging 5%.
I agree, Shweta. That just makes the two of us, honestly. Even I am grappling to find any logic in this 20%, but thinking really hard, I think it boils down to, okay, let's assume that the government is actually going after tax evaders, and tax evaders who are traveling abroad would typically be in the assumed income level of 20 lakhs and more every year, presumption.
Okay.
No numbers, statistics to back me up, right? So if you're in that tax bracket, you owe the government 20% tax. And if you're somebody who's evading that tax, then every time you're making a high value transaction or traveling abroad, the government tries to hold you to that 20% tax bracket and says that, hey, I believe, my assumption is that you owe me 20% of your income. Let me hold this for you. You come back and you reconcile. If you are not liable to pay me this 20%, I'll give it back to you at a later stage. I'll give it back to you. But I think the assumption is that 20% would be the minimum salary tax slab applicable for people who undertake international travel. But of course, the whole MO that the government will have to put in place, and how do you discern whether 7 lakh rupees has been breached or not in the case of credit or debit cards, and how would you tally, let's say, in case a spend being made internationally is for business purpose, an official corporate tour or personal expense, and especially now with families also coming into the ambit. If you are a family person and if you're traveling with a family of 3 or 4 people, then each one of them making transactions, while the taxpayer or the income earner may be just one person or 2 people, then how does the third person who's using a card, not yet earning, maybe still a dependent, 16, 17 years of age, using and still paying 20% tax, how do you sort of reconcile these multiple people paying 20% is logic that eludes me as well. So I don't have an answer for you. I hope people in the finance ministry have an answer to that, and I hope The tax man has an answer to that. Otherwise, we are looking at a lot of trouble at the end of the financial year.
Absolutely, and more importantly, especially, quickly on the credit card debate, because we discussed that international use of credit card. There was a huge backlash from a lot of people asking whether government is preventing us from traveling abroad, and why is that? If that is the reason, why should that be? And we saw after a couple of weeks that there was a revision and there was a limit attested to it, that this is the threshold. If you spend beyond that, you attract 20%. My understanding of this is, now there's not been enough backlash around Forex cards, but we know, but we know with credit card in the ambit of higher TCS, with Forex cards in the ambit of higher TCS, this is surely going to dent people's ability to spend on trips abroad, go abroad, and that's not a very good thing for middle class at this point.
No, I see it differently, Shweta. If the government had not rolled back the decision of the threshold, LRS threshold of 7 lakh rupees, I would have agreed with you, like I did about a week ago. But I think in the case of Forex cards and cash conversion, that product category is going to die. So people are not going to see any merit in opting for a Forex card
anymore.
And they would rather, ensure that the civil rate is okay and they can get a credit card with a sizable value, or load up their debit cards and pay these markup and transaction fees and ATM withdrawal fees rather than a straight up 20% hit on a Forex card. So I think this product category is going to cease to exist over time.
And I need a quick clarification. If someone were to be going abroad, spending less than 7 lakh rupee, use a credit card, would they still be paying 5% TCS?
I don't think so. 5% yes.
5%,
20%
right?
no.
Not 20%.
Not 20%.
20% kicks in only after you
breach the
7 lakh rupee threshold. Yeah. So going abroad there made more and more expensive, as you are likely to attract 20% TCS if you are spending money abroad using a credit or a debit card, but you will still be attracting you're spending more than 7 lakh rupee, but you'd still be attracting a 20% TCS if you are using a Forex card. There is no threshold to that. So any money you spend abroad, each expense will entail a 20% tax deducted at source that you can claim later on if you are eligible, but that will only happen a year and a half later. We're going to move on now. Another important story that we're tracking in the aviation sector, and that is the routes that were primarily driven by Go First, were their primary routes, are now being taken by Air India Vistara and other existing airlines, as Go First is hoping to revive, come back, but that hasn't happened just as yet. But what's important in all of this, and what's concerning even the Civil Aviation Ministry, is the money that you are now going to pay on the same routes, which is as much as 5 times of what you were paying just about a month ago.
Yeah, 5 times on select few routes, like let's say Delhi-Leh, which is not frequented, very, very often in the whole calendar year if you look at it. But yeah, I mean, a good 2x, 3x increase is something that even we have noticed, right? A Delhi-Mumbai flight that would cost you, let's say, 5,500 rupees or so, is now costing you nothing less than almost 10,000 rupees, 9,800, 9,900 rupees. So obviously this was bound to happen, and this is also something, Shweta, that we've continued to talk about on our show more often than one would like. But I think the math is simple. There is demand and supply. Supply has been constrained. Demand increases. Equilibrium goes to a higher point on the y-axis, right? So very simply put, I think as and it's not that somebody from the other airlines is sitting on the desk and curating these prices looking at demand. It's all algorithmically driven. So you have tools which assess how much demand is coming in, and basis that cost gets optimized upwards or downwards. So for example, if you want to take a flight in the evening today, and if the airline that you prefer to fly on has seen a few cancellations, prices will also be revised downwards, because it is very expensive for aircraft operators to carry even a single seat vacant. Even if you make 1,000 rupees on that seat, it is money coming in as opposed to carrying an empty seat. But I think it is a pure function of demand and supply, and until you have more airlines in the fray and unless you have more aircraft flying and plying these particular sectors, and these more frequented sectors get populated with enough and more options, with flights, you know, every 10 minutes or so, it is going to be an expensive affair. So I think we need to pin our hopes on Go First coming back to the skies soon. We need to pin our hopes on a jet making a comeback at some point, and we need to pin our hopes on SpiceJet not going down as well. So we need to have a healthy mix of airlines, otherwise existing carriers will take time augmenting their fleet, will take time getting more pilots, and will take time getting parking bays, permissions, etc., licenses for the additional fleet to fly. Until then, the demand is not something you can control, and is not something you would like to control as an economy. You don't want to discourage people from flying. You want people to fly, you want economic activity to happen. But when supply is limited, prices are going to go higher, and the equilibrium would be met at a 2x, 3x, 5x, depending on the supply-demand gap.
Okay. And, you know, I want to quickly also touch upon price cartelization, because in the last week, the entirety of last week, we've been discussing how fewer flyers or fewer airline options also mean that existing players can sit on the table and decide what the prices are going to be. And I'm giving an example here of Delhi-Ahmedabad route, not a Delhi-Leh route, which we understand is not very populous. It is relatively lean, but Go First operated as many as 52 flights in a week in Delhi-Ahmedabad route. In the past 1 week, prices have surged as much as 400%, and I'm reading this from Business Standard at this point in time, so this is not an independent report. But what essentially we're trying to arrive at here is that these are not routes that are not frequented, these are also routes which are frequented, and there is a massive jump in prices as much as 400%, Karthik.
Agreed, but you know, I would not want to put a put a tag on cartelization just yet.
Okay.
I think it is a clear function of 52 flights a week, give or take. Let's say weekends, if people are not doing Delhi Ahmedabad, you're looking at 10 flights a day. 10 flights a day, each aircraft carrying 300 passengers. To and fro, 600 passengers in every leg. 10 times over in a day, 6,000 people into 5 times a week, 30,000 people. 30,000 people left without a particular carrier that would take them to their destination and back, need to depend on other options available. Now, even if let's say this was just 10% of the market share that Go Air commanded in that sector, will other airlines be able to compensate for this 10% by diverting flights from other profitable sectors into this particular sector? Perhaps not. So, in the absence of other players being able to fill in this gap on the number of flights and the number of seats that can be flown to and fro, price is the only equilibrium balancer that you have.
Okay.
And naturally, if there is 30,000 more demand hitting your servers for a particular air ticket, your server is going to calibrate that and offer it at a price where many from this 30,000 would drop out because it's too expensive for them, and would maybe look at an IRCTC website to take a train if they can, if time permits them and logistics permit them. But those who are traveling for business, or those who need to travel irrespective, will shell out 400% more, 4 times more, and take that flight.
Okay, I would take a train. I think taking a train is not a bad option if it's a short journey. But of course, hopes are pinned on.
So actually, that's why you
Go
need
First.
trains like Vande Bharat also to really dot every sector, every railway station, at least all the big
major
cities,
stations.
all major stations. So I mean, it has to compensate at somewhere for air travel becoming expensive. But again, these are all very, very long term sort of crystal ball gazing. You can't set up new routes even in trains overnight, like you can't get new aircraft overnight.
Absolutely, and so therefore all hopes are pinned on Go First, and hopefully we'll come back shortly, if not late, maybe within a month's time. And of course, DGCA, remember, has asked Go First to a price of whatever steps that they have taken so far in order to ensure that their strategy is in place, that they go back to taking to skies very, very shortly. We will come back on that story, but shifting focus now to Maruti. Shortage of electronic components is affecting production at Maruti. Sales are up, but their production is not meeting the demand just as yet, Karthik. And so back to where we were a month ago, where electronic components shortage continues to affect all major automobile players, but specifically in this case, Maruti.
So, Shweta, yeah, Maruti being the largest car maker in India is also hit the largest in the greatest magnitude when it comes to chip shortage. But yeah, chip shortage is something that we saw kick in during China's zero COVID policy, got exacerbated during the Russia-Ukraine war when supply chains were hit, and now with tensions off and on between China and Taiwan, you know, the possibility of Taiwan also ramping up in the absence of good quality trade and easy trade with China on components, you know, it becomes a very, very difficult issue to tide over. So, it was last year sometime, or was it 2021? I think it was late 2021 when the government had actually allocated 10,000 crore rupees for India's semiconductor industry. And it was parked in a bid outside of PLI to give a major boost, give a major fillip to Indian companies making their own chips. Factories are coming up, production is yet to start. So, we are still dependent on the global trade, and we are depending on global geopolitics and global economics when it comes to importing chips, right? So, yeah, Maruti's production is hit. What does this mean? This actually just means that waiting time for people who have booked their cars gets extended.
Longer.
Right.
Absolutely.
So, waiting time is longer. Cars will get delivered to them. They will be more expensive because of chip shortage, because of overall input cost being high, with inflation in any case hitting every sector like it is hitting, you know, consumers like you and me. The waiting time increases, the costs go up. But time to ring alarm bells, not really on shortage of supply, but alarm bells on, yeah, getting our own chip manufacturing up and ready quickly, right? It should not take a year and a half for the first lot of chips to come out of our own factories. So, we talk about Atmanirbhar Bharat, Make in India,
absolutely,
etc.
and some would say it's been too long. It's been almost a year of Russia-Ukraine conflict. Enough time at disposal to be able to roll out some sort of Make in India program in order to, you know, meet the demand within the country.
Right. So
are we too slow on it? Is that
so? I don't want to actually criticize the government or the private sector because there are challenges on the ground, right? We are inundated with technology transfer, which becomes a challenge. You know, it's not that we have every design of every chip in the world that needs to be manufactured. We don't. This is not something that we had built our core competence in.
okay?
We built our core competence in assembly. We built our core competence in mechanical parts, in glass, in plastic fittings, in bearings, right? In tires. We built our core competence in these very mechanical parts over the last 30 odd years, where we were able to feed into this industry which was willing to come and manufacture in India or assemble in India. We had built distribution lines, but electronics is a new component in cars as a whole, right? You didn't have integrated circuits running, you know, in screens within cars. You had very analog speedometers, tachometers, etc. But now you have electronics. Now you have smart technologies going into cars, right? You need more fuel efficiency. This is also driven electronically. It sort of guides and instructs your cylinders to move in a certain way when you're idling and a certain way when you're revving up. So, we never had this core competence. So, it takes time for the technology to get transferred. It takes time for labor markets to be trained. It takes time in any case to acquire land, set up factories, get clearances, get permissions, and get the sort of, you know, get the assembly line really going. So, it's been 1.5 years. We should have seen some success around now, given the incentive of 10,000 crores that the government was spending. We haven't seen it, but I'm hopeful we will see it at some point. But again, will we see it at such a large scale that it will be able to obfuscate the need to import chips? Not for the next 5 years or so, right? Until then, technology will keep evolving. So, you will still have a country like Taiwan or a country like China or a country like Korea coming up with better chips, and better South Korea, I meant not North Korea, coming up with better technology, more agile technology, smaller integrated circuits, more sort of, you know, reliable machinery, circuitry. which is going to take us time to keep catching up to. At some point, we'll get there.
Right.
We shall overcome. Not tomorrow.
not tomorrow. Not there. Just as yet.
Until then, wait times will be longer. Prices will be higher. But again, there is enough demand. So, is there real incentive for automobile manufacturers also to look at ways to reduce costs? No, I mean, it's okay. As long as the demand is coming, they are producing record output year on year. Selling it at a higher price is better top line for them also.
Absolutely. And order book stretching there for auto major Maruti Suzuki to as much as 4 lakh units, which essentially means that there is enough demand and chip shortage continues to hamper supply. Maruti is expecting some sort of relief, not in the month of May or June, but in the month of July, where the demand and supply could meet an equilibrium and there could be some resolution for auto major in India, and not just Maruti Suzuki, but all other auto companies operating in India. But let's move on for now. Netflix is cracking down on password sharing finally. It has rolled out its policy to crack down on password sharing in the US. As of yesterday, the news coming in, Karthik, is likely to affect hordes of consumers in the US. It hasn't happened in India, but it will happen in India because Netflix has been promising this. It has been promising that it wants to get more and more customers on board. And as opposed to how it started out, which is where I think it's important to point out, Netflix started out as a streaming platform asking people to share passwords, encouraging people to share passwords. Finally, with more competition in the market, Netflix losing money, Netflix now says if you use one password or one account, multiple people using in different geographies, we are going to bar your account. This is a bummer, a real bummer. And I think before we get to why and how, let's start with what has happened so far.
Okay. So, Netflix actually started out earlier as a DVD rental company before it came into streaming services. So, early on, earlier than anybody else in the world, Netflix realized that internet is the future. Soon gone will be the days where people are going to come rent a DVD, play it into a DVD player, sit at home, watch TV, return it in 24 hours or 3 days, depending on whatever plan you had taken on your rental, right? And at the same time, it had realized that maybe binge watching is something people would like to do. And hence, you will not rent out 10 DVDs. You will maybe just stream unlimited content as and when you have the time to. And that sort of pivoted it from a DVD distributor rental company to a streaming giant that it has become. Now, okay, so if you want the genesis, it literally started off as that. It encouraged more and more people to download the app on their smart TVs or on their smart devices and stream content. No breaks, ad-free, no distractions, nothing. The best streaming experience one could ever imagine. It had a very simple user interface, clean, classy, excellent looking posters, and it wanted more and more and more and more and more people to come and watch the content that they had painstakingly and of course spending millions and billions of dollars of acquisition and rights, ownership rights, had curated for an audience. And it wanted more people to explore that. And as a result, it did not really encourage, but did not even discourage people to share passwords. As long as there were more devices streaming their content, as long as there were more geographies, more IP addresses where their service was popular, Netflix was happy. It was growing its market.
But this is where I disagree. Sorry to come in. At one point, Netflix tweeted out, and I quote, "Love is sharing a password." And this is what people are drawing upon as an attempt made by Netflix to encourage people to share the password.
Right. So, sharing legally and sharing illegally, I'll tell you, there's a slight difference. Netflix was the first OTT platform to actually start a multi-screen plan. So, it said you could, and I remember, 5-6 years ago when it came to India, I think 2016, if I'm not mistaken, when Netflix came to India, it had a single user plan for about 699 rupees. You make it a double screen, it becomes 800 or something, 899. Up to 4 screens, you could pay about 1200 rupees per month and legally have your password across 4 different devices.
Right.
So, what people like me did, there was love, and love resulted in sharing. So, I had it on my phone, I had it on my smart TV. So that made 2 devices, but I did share this legally obtained 4-screen password with my father and my father-in-law, who also legally continued to stream Netflix, right? Now what happened is people started misusing that as well, and I'm not guilty of doing that. I still pay for the 4 screens that I use. What people started doing was that you log out of one device, share the password, and your friend or somebody you've shared your love or your password with starts to log in and stream on that device. So that resulted obviously in a revenue loss for Netflix.
That is correct.
And Netflix, in any case, last 1 year or so has been battling with the subscriber base dwindling, with the number of paid subscribers reducing. But it knows for a fact, given the vast proliferation of usage, that there are more people who are watching Netflix than those who are paying to watch Netflix. And that is the crackdown that it is attempting to do in the US.
Okay.
It knows for a fact that I have only X number of subscriptions, but the number of people watching is 10x. The number of screens that I legally permit you to watch on the basis of X subscriptions could be, let's say, 2x or 3x. But the number of people actually watching is 10x. So beyond a point, you've got to have a crackdown on that.
Okay. And how Netflix is doing, that is interesting. Netflix is saying it will be using device IDs, IP addresses, account activity to determine who is in a Netflix household, essentially going by geography. I think that is how it has pinned its crackdown. If there is an account that is operating in this geography, and then there is an account operating somewhere distant, I don't know what the algorithm is, then in that case, the other user will be prompted that they are using an account or a password that is already registered to a certain person in another geography, and they'll have to open their own account. It is very problematic in a lot of ways. That is, if your family members are sitting at 2 different locations, which is what happens.
Or if you're traveling yourself.
Or if you're traveling yourself, how do you then end up verifying again and again that you are the one who's paid for it, and the person who's using it is not you're not sharing it with a random person. It's not that you're taking money from that person. That could be your spouse, your sibling, or whoever. So it is therefore very problematic, and a lot of users have taken to Twitter in the US to complain about how difficult it's going to be.
I think it'll be problematic, but given the simplicity of the UI that Netflix has, I think it would have had the user journey mapped out for a scenario like this. So let it roll out. I think it will be able to understand, given your consumption pattern, given the trend, given the series that you are watching, the points at which you left a series and you continue watching, given your overall user behavior, I think the systems should be very easily, using AI, be able to tell whether it is actually you or it is not you who is watching a particular content, streaming a particular content on Netflix.
Okay.
So I think it'll be easy for them to do it. And if they've been able to do that successfully, they will make it difficult for a non-you to stream something on your password.
Right.
But I think for you, a genuine traveler or a genuine case who has more number of devices registered or has traveled somewhere to go ahead and continue streaming from there. I think as long as your device is the same, if it's a portable device, the series that you're watching is pretty much the same or in line with the content that you watch. It sort of, it subscribes to your pattern as your behavior as a viewer. I think your life should not be impacted. If Netflix does that, if it impacts a real user journey, it'll start losing more subscribers and as opposed to gaining a few.
Right. And what remains unclear from what I'm reading is how people from same household but different locations will be impacted. So if you have if you're living together but you are operating out of different locations, how Netflix is going to figure that out. What I am given to understand, Netflix will increase its standard plan subscribers so that subscribers can pay for 1 extra member that could be added, as opposed to adding screens.
That's right.
You would be adding subscribers, or you'd be adding extra members who will be able to watch Netflix. But Netflix there, as promised, has started its crackdown on password sharing in the US, not in India just as yet. It will be a difficult task, but consumers, of course, complaining on how Netflix is going to work around this. There is a concerted effort made by Netflix and other streaming giants to crack down on password sharing in order to ensure that people who are watching them are the ones who've paid for it. And that is an important story. We will keep bringing you more such stories on this bulletin. Keep watching News9.